Political and economic events can cause certain assets to rise in value while others crash. If you are an event-driven trader looking to capitalize on price fluctuations in top financial assets, the US elections are a key event to consider. You can trade the US election in several ways: by hedging your positions, trading in safe haven assets, and minimizing risk using other execution tools. Popular assets to trade during this period include the US dollar, Dow, S&P 500, and gold. But how do these asset classes get affected by the US elections over the last 10 elections? First, the US equities. US equities tend to shine under Democratic presidents. In each of the last 5 presidential elections, the S&P 500 has fallen in the month leading up to the election. Additionally, the S&P 500 has gained ground in quarter following an election 8 of the last 10 times. Analysis of the last 10 presidencies shows that both equities and bonds perform better when the governing party lacks a majority in Congress. The more resilient economic growth and high inflation under Democratic presidents may in part explain the historical pattern. Commodities now. Election results can reshape commodity markets with trade policies and geopolitical shifts potentially impacting global supply and demand dynamics. Gold, more precisely, has generally weakened in 3 months after US presidential elections, albeit with notable exceptions in 2004 and 2008. And last but not least is Forex. US elections can influence Forex markets with potential shifts in trade policies affecting currency strength across various regions. However, the US dollar has not shown a consistent trend of strengthening or weakening before or after the US elections, over the last 10 elections at least. Key aspects for trading the US elections, however, it is to manage properly your risk. Adjusting your trades can help you navigate the potential risk linked to the election's outcomes. So here are 5 ways to consider as the political landscape shifts. Assess how your portfolio aligns with sectors and regions that might be impacted by either party's victory. Utilize options to hedge against potential market movements or speculate on election results. Evaluate how commodity prices might be affected by proposed policies and adjust your holdings accordingly. Pay attention to currencies, especially those sensitive to US policy changes, and ensure your exposure aligns with your expectations of the election outcome. If uncertain, diversify your trades by incorporating ETFs that focus on sectors more or less likely to be influenced by the election results, based on your position strategy, of course.